Banks are collapsing left and right. People can't get their money and aren't getting paid. How am I going to afford my Starbucks venti cappuccino? The end of the world is near. Hold on, everyone. Yes, the world of banking has been put under the microscope these past 2 weeks with SVB, Signature Bank, and most recently Credit Suisse. The world is not ending anytime soon that I know of. So why are we hearing so much about banks collapsing in the news and social media? In today's video, I want to talk about what happened and how you can protect yourself now and in the future. Welcome everyone, Jonathan here, and let's get to talking about banks. Not this piggy bank, of course, actual banks. If you're on this channel, you care about your finances. Knowing what is happening around you in real time can help you sustain your current goals or make calculated changes if need be. Let's get started. Let's start with Silicon Valley, or SVB. They're a bank that focused heavily on providing services to startups and entrepreneurs. Many companies use the bank to hold their funds from venture capitalists, aka the guys with a shitload of money who invest into companies they deem to be worthy of financial backing. Back in 2021, the market was soaring high and startups were getting tons of cash daily. Banks normally make money by loaning out money from their clients that they hold, but at one point, SVB was bringing in so much that they couldn't loan it out in time. What a problem to have, right? Too much money. Speaking of problems, can you help me out with one? I need likes and subscribers. If you can like and subscribe right now, that would be wonderful. Okay, back to SVB. This forced SVB to buy into long-term investments like bonds that mature over a set period of time. Everything would be good until the Fed started raising interest rates last year, while the market value of those long-term assets took a nosedive. At the same time, tech and startups now dealing with increased rates started laying off workers and decided to withdraw from accounts faster than ever. SVB would now need to sell off those long-term assets at a loss to support all the withdrawals going on daily. To make up for those withdrawals, SVB sold over $2 billion of investments while taking an almost $2 billion loss to raise cash, protect their balance, and improve the financial health of the bank. As more and more investors got wind of what was going on, there was a run of the bank. Run of the bank is when too many account holders request withdrawals all at once. Banks can handle when you withdraw money, but not at the capacity that SVB experienced. Deposits were locked, people were concerned, and startups started to panic. SVB had failed its clients and was done for. Signature Bank is a bank that lent largely to real estate companies and law firms. With news of SVB collapsing, clients of Signature Bank were spooked and withdrew more than $10 billion in deposits. With that amount in such a short amount of time, Signature also had a run on the bank, causing it to fail itself and its clients. So there you have it. What led to SVB and Signature to failure? As of this video being published, SVB and Signature is the second and third biggest banking failures in the United States. What will happen down the road? This could be anyone's guess. Is this issue contained, or are we just seeing the beginning of our generation's financial crisis? Regardless of those banks' poor management of their assets, you should be able to keep control of your finances. Here are some suggestions on what you can do to protect yourself. Number one, keep under the required FDIC amount. Most clients are FDIC insured, which means up to $250,000 of your money is protected in case of another run of the bank, for this example. By keeping your amount under $250,000, you are protecting your money. Now, most people will never have to worry about this scenario, but for the extremely wealthy, using multiple banks is a powerful tool in their arsenal. Number two, diversify. By expanding your assets into different segments and markets, you can protect yourself. For example, stocks, bonds, and short-term investments are always a good option. Number three, real estate. Putting your cash into real estate is always a sound choice. By diving into real estate, you can make passive income with rentals, while also benefiting from the appreciation of your property over the years. Also, don't forget about all the tax advantages. Will more banks crumble? Honestly, time will tell. That's gonna be it for today's video. If you enjoyed this video, please go ahead, like it, comment, and subscribe. I would truly, truly appreciate it. Thank you everyone for stopping by, and I will see you on the next one.